What's up guys, my name is Andrei. Today I'm gonna share with you guys some of the mistakes regarding investing that I made in the past. This will help you have a better idea on what not to do when you first start buying stocks. So if any of you guys wanna buy stocks, you will need to open a brokerage account. By opening a brokerage account, you will be able to buy stocks on the stock market. Feel free to use any of the links that I put in the description below. You will find various options, for example like Fidelity, my favorite, eToro, Moomoo, M1 Finance, and so on. I hope that you find the best one that suits your needs. And now let's get back to the video. Lower your average cost price. First things first, on my list personally, I try my best to lower my average cost price. Let's take a simple example so you can understand. What do I mean by lowering my average cost price? That means, for example, today you buy 10 shares of a stock. Each share is worth $20. You spend in total $200. Tomorrow the same stock has a lower price. Now it's not $20, it's $15, and now you still have faith in the stock, you don't panic, and you still buy again an additional 10 shares of that stock. Now everything adds up to $350 for 20 shares. Now if you want to get the average cost per share, you will have to divide 350 by 20 shares. $350 divided by 20 shares equals $17.5 per share. What I want you guys to take out of this is, if you really believe in a company, if you really know that the company has huge growth potential in the future, you made your due diligence, you made your research, try your best to buy shares of that stock at a lower price. It's simple math. The lower your average cost basis, the higher potential profits. Number 2, please, I beg you, don't focus on dividend yield or yield. I learned this the hard way, risking and ultimately losing a part of my hard-earned cash. A while back, I was really focused on creating a high-yield dividend portfolio, and that misfired. I don't know, I didn't do all my research. I was only focused on the yield. I made a lot of mistakes. So for me it didn't work. Maybe for you guys it works, but in my opinion, try to not focus on the yield. That's not the only thing that's really important in this game. So don't focus solely on the dividend yield, please. Don't let other people influence you when making your own investment decisions. I guarantee you that if you're investing in stocks, for sure you heard the next best thing, the new hype stocks, and most likely if you dig a little more deeper, you will find that those stocks are not the best fit for you. Try to avoid following other people's decisions and try to make your own decisions based on your own research. Just try to own your decisions so you learn the hard way, or if you win by making your own decisions. Back in 2022, I invested in one of these hype stocks. I invested in Bed Bath & Beyond, and it seems like everyone was talking about it, like for the potential gains that they would have in the future, or at least trying to trade in and out of the stock. Despite this, I got really excited, and without knowing the company's fundamentals, I invested around 6% of my portfolio. Unfortunately, the hype didn't match the reality. The stock price took a nosedive in a short period, causing me to lose a substantial part of my investment. It's crucial that you make your own decisions based on experience that you learn from other people, but also try to be your own guide when investing in stocks. Most of the times, if I really need to get more information about the company, I use Seeking Alpha. I reached the point that I don't even consider buying a stock without checking Seeking Alpha first. Here on the platform you will find a lot of useful information, valuations, articles. These all combined will help you decide what stock is the best fit for your investment style. Right now they have a special offer. They have a 7-day trial, and also they will give you an extra $50 coupon that you can use for the whole year subscription. And in total, for one whole year subscription, you will pay $189, and that comes out to around $16 each month. Once more, in my personal opinion, I think Seeking Alpha is a great asset that you can use so you can improve your overall portfolio performance. So if you're really interested in subscribing for a whole year subscription and also getting the $50 coupon, make sure you use the link that I put in the description below. Number 4, don't get attached to stocks. If you invest in stocks, for sure you heard about the most popular monthly paying REIT, Realty Income. I had Realty Income for a while now in my main portfolio due to its past performance and also because it pays a monthly dividend. However, lately I just started noticing that the stock price is going down due to high interest rates that affect the housing market. Unfortunately, due to the poor performance of the stock, I had to make some decisions. I decided to mix up my investments, looking for better opportunities that I can get more money in the long run. Even though I still believe that Realty Income is a great company to own, that will still pay you monthly dividends and most likely will continue increasing the dividend payout per month. For now, I decided to sell out my position in Realty Income because, in my opinion, I think I found better opportunities in different sectors that I can get more money in the long run. Don't let emotions rule your investments. Staying calm during changes in the stock market is really important. Don't let your emotions, for example like fear or excitement, make you take poor decisions. Think of it like this: when the market experiences a decline, use it as an opportunity to buy shares of a stock at a lower price, of course, if that stock is worth it in the long run. Stick to a smart long-term plan, avoid sudden decisions, and also remember that most of the times the stock market bounces back. Keeping calm and thinking clearly in uncertain situations can lead to better performance in the long run. Diversification. Diversification is the vital strategy for building a resilient stock portfolio. It provides risk control and also minimizes the impact of the market fluctuations. This approach will allow you to take advantage of the different opportunities that you might find in other sectors and global markets, and also will allow you to adapt to the economic cycles. Regular portfolio reviews will enable you to make smart adjustments and also will align yourself to the conditions of the market for long-term stability. By diversifying your portfolio, you will not only safeguard your investments for a long period of time, you will also gain valuable information in financial market dynamics. Previously, my investment portfolio was mainly focused and concentrated in owning real estate investment trusts, or REITs how we call them. Recognizing the importance of diversification for the overall performance of our portfolio, I've since made strategic changes so I can broaden my investment horizon. Fast forward to the present, my stock portfolio now spans and encompasses a diverse array of stocks in different sectors. Once more, to recap, this shift allowed me to take advantage of growth opportunities in different sectors, manage risk more efficiently, and also helped me to better adapt to the market fluctuations. Invest on a regular basis. Make it a habit to put a part of your money into the investments that you have currently. Is like paying yourself first before other expenses. It's similar to saving a little bit of your paycheck to prioritize your financial growth. Just think of it like paying for another subscription. You will be paying for your financial future. The key here is consistency without trying to predict the market. This is known as dollar cost average. Trying to guess the market moves in the short term is pretty tricky and usually doesn't end up well. Personally, if you ask me, I will try my best to have a long-term plan. I will remain invested even if the market goes up and down. I will continue to dollar cost average in the stocks that I really like. It's really important to be patient, disciplined, and calculated with your investment decisions and let your investments build up over time. Number 8. Learn from setbacks. While investing, acknowledging mistakes as vital learning opportunities is crucial for your success. Each financial decision, whether successful or falling short, offers insight for improvement. When an investment doesn't go as planned, it's beneficial that we understand and analyze the situation thoroughly. By learning from this experience, you will make better and more informed decisions, and this will also improve the outcome of your future investments. Embracing this mindset will foster resilience, giving you an adaptive approach to the continuous journey towards your financial success. Number 9. Don't invest if it's not worth it. You have to be cautious while choosing your stocks, so they're not too risky and also they fit your goals. A much better approach will be to just invest a small percentage of your portfolio in, let's say, more riskier and more speculative investments. So if those investments don't end well, you will not lose all your money. Just by doing this, you will make sure that your investments match your financial goals, you will be reducing unnecessary risk, and also you will be increasing the chance of success of your portfolio. Try to avoid as much as you can random hype investments. Exercise caution when making investments hyped up by the crowd, especially if they deviate from your strategy. This principle is comparable to attempting to fit a square peg in a round hole, a scenario where compatibility is lacking. Simply because a specific investment is really hot right now, that doesn't ultimately make it a suitable fit for your portfolio. Instead, prioritize your investments so they match your financial goals and ultimately try to avoid the hype stocks and the new hot thing. Stick to this method so you don't get caught in the market excitement. This way your investments will be based on a clear strategy and exact goals. Before we wrap up, let's recap the key points that you should remember from the video. Strategic investment. Be strategic in your investments by reducing the overall cost price when the opportunity arises. This involves buying stocks at a lower price, reducing your overall cost base. Diversification matters. Diversifying your portfolio so you spread out the risk, and also you will take advantage of opportunities in different sectors and different global markets. This ensures long-term stability, and also your portfolio will have resilience against the market fluctuations. Emotional intelligence in investing. Avoid letting emotions like fear or excitement drive your investment decisions. Stay calm when the market declines and try to use this opportunity to buy stocks at a lower price, and also adhere to a long-term plan and strategy. Learn from your mistakes. We have to learn from our mistakes. We have to see why our investments are not going so well, so we can use this knowledge in making better and smarter decisions for future investments. Avoid unwise investments. Be cautious when your investments don't match your goals, and also if they carry unnecessary risk. Stick to your plan, resist external pressures, make sure that your investments match your financial goals. I hope that these key points will be of good use to you, and also try to avoid making the same mistakes, most of which I made in my financial journey. Keep in mind that investing of any kind has its own risks. You have to do your own research, and also if you need, consult a financial advisor and not just listen to random people on the internet. Thank you guys for watching. If you find this video helpful in any shape or form, please give it a like, or why not subscribe to see what's coming next, and I will see you in the next video. Peace.